talk first we'll just introduce myself and my firm. Then we'll talk about the 1031 exchange. Separately, the DST. We'll do a short case study where we include a DST into a 1031 exchange, and then I'll leave you with my contact info. So with that, let me start by introducing my firm. So I founded Aimpoint Investments as a real estate focused financial advisory firm. So we focus in four key areas. The first is 1031 exchange consultation. The second are by offering DST investments for 1031 exchanges. Those two areas are highlighted because that's what we'll focus our conversation on today. But we also offer what are called qualified opportunity funds, as well as alternative real estate investments. And these are private equity strategies that are able to offer investment options outside of the stock market, but focused in real estate with some oil and gas. So we are a financial advisory firm, but we don't do any stock and bond advice. We are focused almost exclusively on real estate with some oil and gas. By way of personal introduction, so Linda very generously introduced me and touched on many of these points, but I am the president of Aimpoint Investments. I hold a Series 7 and 66 license in this role. I do have a background in real estate by education as well. I hold a master's in real estate from Fordham. I also did an MBA program on the East Coast, and I am now located in Santa Barbara, where I did my undergrad at UC Santa Barbara. So I think a lot of listeners are going to be in California today. I'm in the Central Coast in Santa Barbara. I did start my career as a residential real estate broker, but I moved into an acquisitions role where I was evaluating, sourcing, and performing the due diligence on medical office buildings. We had close to $2 billion under management. The portfolio is still around today. I believe they're the largest private medical office portfolio that is around. They're no longer located in California, but I took a little bit of a career detour, as Linda mentioned, and I served in the Navy. I was able to fly the F-18 Super Hornet and love to talk airplanes, so we could easily pivot this into a conversation about airplanes. But I'll just leave that point with you. I shared a photo there of my wife and myself on my last day in the Navy, flying the F-18 in 2017. Aimpoint Investments. So I work with a lot of commercial and residential real estate brokers and agents, a lot of CPAs and estate planning attorneys. And we offer a different approach in that we offer access to the entire market of DSTs. We look at all 68 sponsors as of 2025. There were 68 different operators that offered DST product. And we look at the entire marketplace. We don't approve everything, but we look at the entire marketplace. So it's access, number one. Number two is expertise. We have a firm of very experienced real estate professionals, over 100 years of combined experience in real estate securities. I have a very long number of years in real estate as well. So we understand the real estate that we're introducing and recommending to our clients, and that expertise is very critical to good client outcomes. And then finally is approach. We'd like to partner with CPAs and agents and attorneys to help deliver solutions for their clients, and partner with those professionals to ensure that they have access to these solutions for their clients. So that's Aimpoint Investments, and that's me. With that, we'll jump right into the 1031 exchanges, also called a like-kind exchange. And the way I'll set this up is just by saying that most people are familiar with what's called the Section 121 exclusion. So if we meet the primary residence test on the ownership of a piece of property, and that primary residence test is owning it as a primary residence for 2 out of the last 5 years, we can exclude up to $500,000 of capital gains if we're married. However, if we own the property as an investment, we don't have that Section 121 exclusion available to us. But we do have the Section 1031 exchange option available. So we're going to step into some of the mechanics, but before I do, let's look at some of the taxes that we may owe on the sale of investment property. Again, I'm not a CPA, but this is sourced from the irs.gov website that when we sell an investment property, we may be subject to 4 different layers of tax. The first and most forgot about layer is what's called depreciation recapture. So to the extent we depreciated the property during the holding period, that accumulated depreciation will be taxed at a rate typically 25% when we sell the property. We also have long-term federal capital gains tax at 20% or 15%, depending on the income, as well as the net investment income tax of 3.8%, as well as state layer taxes. So the 0 to 13.3% for California residents, that we represent the 13.3% there. So the total taxes owed on the sale of an investment property could be as high as 42% on some portions of the gain. So very significant taxes potentially owed on the sale of investment property. And why we are thinking about taxes is paying a capital gain tax is incredibly dilutive to our wealth creation. So if we look at this scenario, if we take a $1 investment and we double this $1 every period, representing an investment in a piece of real estate, and we look at the scenario where we pay a capital gain tax every time we sell, every time we double, and we look at a scenario where we don't pay a capital gain tax when we sell, the difference is phenomenal. So let's look at doing this just 5 times. So if we have $1 that doubles 5 times, if we don't pay a capital gain tax, we end up with $16 at the end of those 5 periods. If we do pay a 30% capital gain tax, we end up with $8.35. So just under 50% less wealth is created in the scenario where we're paying capital gain tax on each sale. If we take that just to demonstrate the significance of how the capital gain tax erodes our wealth, let's look at that over 20 periods. You can see not paying a capital gain tax results in 525,000 approximate wealth, where with the capital gain tax, it's only 24,000. So 95% less wealth is created over 20 periods of doubling. So that may or may not be realistic over our lifetimes, but it just shows you how divergent the 2 paths of wealth creation are between paying a capital gain tax and not paying a capital gain tax. So a prudent investor should always be looking for ways to mitigate, minimize, or avoid paying the capital gain tax. And that's where we get Section 1031. So a 1031 exchange is called that because that's the section of the Internal Revenue Code that describes our opportunity to exchange. This is the actual language of the code, but it basically results in 3 requirements. The first being that the property that we're exchanging must have been held for business or investment use. Second, the properties that we're exchanging from and to must be like kind to each other. And all that means is that it must be investment property for investment property. It doesn't mean that if we sell a single family residence that we rent it out, that we have to buy a single family residence. It just means investment property for investment property. So land for single family residence, farmland for a duplex, multifamily for commercial, all of that applies so long as it was held for the purpose of investment. And then finally, the transaction must be structured as an exchange. This is distinct from simply selling a property and purchasing a new property. We structure it as an exchange by incorporating a qualified intermediary, which is a company that's going to hold the investment proceeds or the sale proceeds from the sale of the relinquished property until we purchase the replacement property. We'll get a little more into that here in a moment. To give you some history on the 1031 exchange, it's been around since 1921. The big changes were in 1954, they adopted the current definitions and transaction structure. In 1984, they imposed some of the timelines or the deadlines that we'll talk about a little bit more. And the most recent change was in the 2017 Tax Cut and Jobs Act. We eliminated the ability to exchange personal property. So those pieces of real property that had equipment or machinery or even cattle, livestock, the opportunity to exchange those portions of the property was eliminated. So today we can only exchange real property. Here are some important terms. I won't belabor all of these, but as I already referenced, a relinquished property is the property we are selling. The replacement property is the property we are acquiring. The qualified intermediary is the third party that holds the proceeds in between the sale and the purchase. And then we have some other terms. I won't get into those, but boot, depreciation, and depreciation recapture are all critical terms during the exchange. Let's talk about types of exchanges. So we've got four basic types that we'll talk about. Today, we're going to focus just on the first, a delayed or forward exchange. That's your garden variety transaction where we're selling our relinquished property first, and then we're purchasing a replacement property second. However, we can do that in reverse, and we're seeing this a lot more commonly in markets where properties are taking longer to sell. We have buyers that are finding a replacement property they like first, and they want to go under contract and purchase, but they haven't yet sold their haven't yet sold their relinquished property. So this is where we can perform what's called a 1031 or a reverse exchange. And that's just where we do it in the opposite. We can also do a simultaneous exchange. That's basically a title swap on the same day. I've never seen that. And then we can also do what's called an improvement exchange, where we acquire maybe raw land and we use some exchange proceeds to improve the property or build on the property. We're not going to talk more about that, but it is an option for those exchangers that want to build or improve a property. When you're initiating a 1031 exchange, the first step is that you want to consult an advisor. I can be that advisor. If you have an attorney or a CPA or a qualified intermediary in your network, they can consult to just ensure that the mechanics and the qualification is satisfied, to ensure the exchange is properly structured. We have to bring in the qualified intermediary before the sale of the relinquished property occurs. It generally takes them about a week to set up the exchange account, but it's critical we get the property owner established with a qualified intermediary to ensure that exchange is available to them. I've had countless calls from exchangers who have closed on their sale, and they call me a week later and ask to do an exchange, and the money from their sale is sitting in their own account. They've taken what's called constructive receipt of those funds, and they can no longer perform an exchange. So if you take one thing away from this, please know that before the sale closes, we have to engage a qualified intermediary. And some of the things we provide the qualified intermediary will include the purchase and sale agreement, taxpayer information, and certainly the contact info for the escrow or the closing officer at the title company who's handling the closing. Some of the due diligence that I will do and that any of the other advisors should be doing is just first qualifying that the property is held for investment. So there are some holding period considerations. These aren't written in the tax code, so there is no defined holding period in an exchange in terms of how long we have to hold a property that we're selling or one that we're buying. but most CPAs and attorneys will reference either a 1 or 2 year holding period to ensure that if the exchange is audited, we can comfortably assert that the property was held for investment. Notable here that often property flips would be treated as held for resale or held for sale properties, not as investment properties. So characteristics of holding a property as an investment often include taking depreciation, generating rent. Facts and circumstances will be evaluated if the exchange is audited, but some of these are characteristics of holding properties as investments. And then we'll also want to make sure that we're aligning the same taxpayer rule. So when we sell a property, the taxpayer on the sale has to match the taxpayer on the replacement. And where we see this coming up often is when a partnership or an LLC or another entity owns the relinquished property, but you want to make some change as to what the partnership looks like or what the entity looks like on the replacement. That can create problems. We would want to engage an attorney to ensure that we're not violating the same taxpayer rule. We can do what's called a partial exchange. So if we're selling an asset and we want to extract some proceeds from the sale, we would be doing what's called a partial exchange. We would be pulling some cash out of the property. When we do that, it's important to note that if we take any dollars out, that's treated as boot. It's a benefit that we're getting from the exchange, separate from the purchase of the replacement property. Important to note that boot is generally taxable, and the first dollars that we extract are going to be treated as capital gain in the most unfavorable tax treatment available. So we can extract money from the exchange or elect to not exchange the full amount of our proceeds, but we will likely have a tax consequence. And it's important, if we do want to withdraw from the exchange, to notify our qualified intermediary before we close. Because if we determine we want to exchange for less than our full amount of proceeds while the qualified intermediary is holding funds, they may have to hold the proceeds until the exchange period ends, which may be up to 180 days. So we'd have to wait to get our cash in the event we didn't elect to extract those proceeds before the sale of the relinquished closes. There are a few important deadlines here that we need to be aware of. In a forward exchange, on the date that the sale of the relinquished property closes, a clock begins. And at midnight on the 45th day, we have to have submitted our identification worksheet to our qualified intermediary. And then beyond that, we have an additional 135 days to actually close on something we identified. So the 45 plus the 135 gives us that 180-day exchange period that you see here. Important to note, since we're just getting into a new year, that this period is reduced if it's a carryover, a sale from 2025, for example, that we have a 180-day period, but it's shortened if we file our tax return prior to the 180th day. So at no time is it going to be more than 180 days unless there's some exception that the IRS issues, but it may be shortened if we file our return before the 180th day. We have specific rules that we have to observe when we're identifying. And the most common of these rules is the 3 property rule. And this is simply where we can identify 3 properties regardless of their market value. But we also have the 200% rule. And this is where we can identify any number of properties such that so long as that their total aggregate value does not exceed 200% of the value of the relinquished property. So as an example, if we sell a $1 million property, we can identify up to $2 million worth of property across any number of properties. And then finally, we have a uncommon but catch-all rule called the 95% default rule. And this is where we can identify any number and any value of properties so long as we close on at least 95% of what we identified. It's not a rule I see very common, but or see used very often, but it is an option. So just to kind of bring this all together in a picture form, if you see our relinquished property there on the lower left side of this slide here, when we sell the property, the proceeds from the sale are going to go directly to the qualified intermediary, and that's going to initiate our search period. We've got 45 days to identify a replacement property and that additional 135 days to close. When we're ready to close, the proceeds will go from the qualified intermediary to the seller of the replacement property that we're acquiring. And once they're closed, our exchange is complete. Introducing the exchange equation. So we talked about getting a full tax deferral. Important to note, this is a deferral of our capital gain tax. So it doesn't eliminate it. It simply defers it until a future date at which we no longer perform a 1031 exchange. And in this case, as an example, we sold a $5 million property. We paid off some debt and some sale costs, and it resulted in the net proceeds or a net equity amount of $2.2 million. Now, the two requirements we need to meet for a full tax deferral is we have to replace all the debt, so the $2.5 million in this case, and we have to reinvest all the net equity, the $2.2 million. So in this example, we acquired a property that was $5.2 million. We put debt on the property of $3 million, so we increased the amount of debt that we had, and we reinvested the full $2.2 million of net equity. So we replaced all the debt and we reinvested all the equity. So as a result, we've got no boot. So we should receive a full capital gain tax deferral on this 1031 exchange. Now, if we look at a scenario where we do receive some boot, so this would be treated as a partial exchange. So we sold the same property, but now we purchased down in value. So we acquired a replacement property that was only $3 million. We put new debt on of only $2 million, and we only reinvested $1 million of the $2.2 million. So in this case, you can see on the debt line, we received a debt forgiveness of $500,000. So that's treated as mortgage boot. And then we also did not reinvest $1.2 million of our equity. That's treated as cash boot. So together, we have total boot of $1.7 million between the $500,000 mortgage boot and the $1.2 million in cash boot. So that would likely be taxable. And in this case, we would have to evaluate whether the exchanger is even getting any tax benefit from the exchange at all. So those are two examples. When we're complete with the exchange, our CPA is going to file this form. This is the IRS Form 8824, and we're going to report the exchange to the IRS in our tax return. You can see it's a 4-part form. But this is a critical form in order to report the exchange. We're going to calculate the basis on the new asset on this form and establish a new depreciation schedule for the new asset. But this is the final step of completing the exchange, is actually reporting the exchange. And then, of course, the IRS has an opportunity to audit the exchange if they audit us at random or want to ask for more information. That concludes the 1031 exchange, but I want to highlight some common challenges that we see. So first and foremost, the exchange equation, or unexpected boot receipt. So when we're selling a $5 million property, generally speaking, we need to buy as much or more real estate. If you think of those two rules, replace all the debt and reinvest all the equity, what those generally mean are we need to reinvest all the equity, but buy as much or more real estate. So we often see problems where exchangers are looking at properties that are lower in value than their relinquished property, and that can create some unexpected boot. We also have limitations on what's available in the market. So some investors are looking at very small geographies. They sold in Santa Barbara and they only want to buy in Santa Barbara in a certain price point, a certain property profile. And the question becomes, is there a property available that meets our requirements? Missing deadlines is a very critical point, and there is no flexibility on these deadlines. If we approach that 45-day ID deadline, we have to submit an identification or our exchange will fail under audit. Closing on the replacement, that's often a problem where we go under contract on something, but we complete or our ID window ends, our deadline has passed, but we only then start the due diligence on the new property and we uncover a condition issue. Maybe there's a problem with the getting the property insured, or there's an issue, a physical defect, the foundation has a flaw, and we decide we don't want to close on that property. Unfortunately, we can only close on what's been identified after our ID deadline has passed. So very critical that we get that information as early as possible to ensure that we have the ability to close on the property. Getting financing can be tough, especially now interest rates are higher often than people expect. Underwriting requirements from banks may be challenging, especially if it's a commercial asset. So we want to make sure to start those processes early to ensure that we can close and complete the exchange. And then finally, what we're hearing from a lot of our clientele is that they're tired of managing property, particularly here in California, where we have more tenant-friendly regulations. We have some rent control policies. In fact, there's a rent freeze ordinance that passed just last week here in Santa Barbara. And LA is subject to some rent control policies. So people are getting less and less interested in managing tenants within California and just more broadly. So that becomes a problem. People say, I want the benefit of the exchange, but I don't want to end up owning a property where I manage tenants. So with these challenges, I want to introduce the idea of a Delaware statutory trust. So a DST is a way to own real estate where the investor owns a fraction of the real estate rather than 100% of the real estate. Now, the way a DST is created is a professional real estate company, an operator referred to as the sponsor, will go into the marketplace and find and acquire a commercial property. They will establish a trust under Delaware statutory trust law, and they will move the property into the trust. And now the trust, the DST, owns the property, and the sponsor will sell the beneficial interests of that trust to exchange investors. So when an exchange investor is looking for a replacement property, a DST property is one option available to them. So the DST is one of two ownership options or exchange options where we feel like a partner, but our individual interests in the property are treated as direct ownership of the real estate. So the two different structures that are available to us are called the tenants in common, the TIC, or the DST. These were both recognized by the IRS through IRS revenue rulings in the early 2000s. The TIC in 2002, the DST in 2004, but they do have some notable differences. The biggest differences are, number one, the TIC is generally limited to only 35 investors. The DST can have up to 500 or just under 500 investors. So when we're looking at the institutional quality properties that we're acquiring in this structure, limiting us to only 35 investors would limit us to lower dollar properties. So The DST has become a little more preferred for that reason. But additionally, the management responsibilities are slightly different. So in a TIC, often the TIC members will vote on asset management decisions. Whereas in a DST, the sponsor is the trustee of the trust. They act as a fiduciary on behalf of the investors, and they alone make all the operational decisions on the asset. That's an important note and an important difference, because what we saw with TICs leading into the global financial crisis is a lot of TIC managers were promoting some action from the TIC members, and the TIC members couldn't agree. They couldn't get to a vote to agree or take the action that was being recommended to them. And they did see some TIC properties go into foreclosure during the global financial crisis. The DST has corrected that in some manner by allowing the most experienced and familiar party, the sponsor, to make all the asset management decisions. The additional big difference is that in the DST, a requirement on the structure is that the debt on the property is non-recourse to the investor. Whereas in a TIC, generally each individual investor will be underwritten by the bank that's lending on the asset. It's a very important distinction because it makes the benefits of having debt on the property not carry any recourse or guarantee from the investor in the case of a DST. So we're going to jump into just some kind of data about the market for DSTs. So in 2025, the equity column there you can see is the equity raised for DST programs. That's in millions. So last year there was about 8.4 billion, 8.4 billion with a B, dollars of equity that flowed into DST structures. And an important side note is about 36% of that equity came from investors that were based in California. That was the number one state where this equity flowed from. The second most popular state was New York, where 8% of that equity flowed from. So California owners, there's a lot of course, high dollar properties in California, but there is an exodus of some note of capital from investment property in California into DSTs. It's very suitable for a number of reasons. You can see that was done, that 8.4 billion was raised across 255 different programs or properties and 68 different sponsors. So each sponsor averaged just under 4 DST offerings per year. When we look at the equity by property type within the DST, industrial and multifamily are about a third each. In fact, this is the first year where industrial overtook multifamily as the highest property type. Historically speaking, multifamily has been the most common property type in the DST structure, where industrial has now taken the top spot. So those two account for about 2/3 of the total property types, but we also see retail, senior and student housing, medical office, hospitality, storage. So all different property types are available in this structure. And the notable benefits here are, number one, this is passive ownership. So a lot of people invest in real estate thinking of real estate investment as passive income, but anybody who's owned and managed tenants knows that is not accurate. So in this case, we don't have any late night calls. We're not managing the 3 T's, the tenants, toilets, and trash of property management are completely eliminated when we invest in a DST, but we still receive all the benefits, 1031 exchanges, mortgage interest deduction, depreciation. All the benefits are preserved of real estate ownership without the management. We also get access to institutional quality properties for very low investment minimums, usually around 100,000. We talked about how the debt is non-recourse. And we also should note that these are fully packaged and available before they get recommended to the client. So they can They can be identified and they can be closed on in very short periods of time. In fact, I've done from introduction to investment closing. We can do that in as few as 2 or 3 business days if we're in a bind. We can also create a diversified portfolio. So rather than have a concentrated position where someone owns a $2 million or a $3 million asset, and they're going to look for a new $3 million asset, we can fracture that across multiple DST properties. And we're not stacking management because there's nothing to manage. We get the benefit of diversification, different property types, different operators, different markets, but we don't have to manage anything. So it's a great way to diversify a concentrated position. We can also invest to the dollar. Part of that exchange equation is how do we exact the amount of proceeds that we reinvest or how much we need to borrow to purchase the exact right property. In this case, if we have $824,000 and change left, we can choose a DST with that amount of equity available and just invest directly to the penny. And then finally, even though we act as a partner, or it feels like a partnership experience, we exchange into and out of a DST property as an individual investor because our fractional ownership is treated as direct ownership of the asset. Now, as a financial advisor, I of course have to highlight some of the risks of DST ownership. And the number one concern we get is that there is no investor control. So part of the benefit of having someone else do the work is the other side of the coin, which is that we don't get any control. So the DST sponsor is going to make all the operational decisions, including when the property is sold. We also need to be aware that these investments are going to be illiquid during the hold period. So generally speaking, these properties are held for 5 or 6 years, but typically they'll advertise a 5 to 10-year holding period. The sponsor ultimately decides when to sell the property. And they're looking to optimize total return for investors. So often they will sell at a time that maximizes total return for the investor. And that may be a little earlier, or they may need to hold it a little longer if the market isn't great. But ultimately, the sponsor makes that decision. There are some fees and a sales load that are involved. And this is generally considered the cost of doing nothing, but it is going to have an impact. The other side of that is we often do benefit from some efficiencies that the sponsor provides. So often the sponsor is a preferred borrower from Fannie and Freddie. They may have economies of scale because they own a large portfolio of assets. They get better premiums on insurance policies. They may get lower cost property management. So there are some benefits of investing alongside a sponsor with a very experienced track record, but there is going to be some drag through the sales load and the fees that are incurred by the investor. It's also important to note this is still real estate. So thinking of this as a lower risk option is not the right way to think of this. It may be a little more predictable in some ways in terms of how much the property will cost to maintain or how much rent we can generate, but it is still real estate and it's subject to the same risks as any real estate ownership. And then finally, the structure is limited in the amount of growth it can recognize or realize because the structure doesn't allow us to do large value add projects. So we can do minor upgrades to properties that are in a DST, but we can't build or develop in the structure. So that limits some of the growth potential of these vehicles. So with that said, I have well, here we have a slide where we can talk about ways to utilize the DST in your exchange. So if you're thinking about doing a 1031 exchange, it's important that you are aware of the DST because number one, it can be a great primary replacement. So somebody that wants to go to a passive ownership may elect to use the DST as their sole and primary replacement option. So that becomes got a little delay. There we go. So a primary replacement is generally speaking for somebody that wants that passive ownership, or they have an estate planning challenge, and the DST helps them simplify the estate plan. And there are a number of other reasons why someone would choose this as a primary replacement, but it can also be used as a complementary replacement. So that scenario where we're exchanging down in value, selling a $5 million asset, acquiring a $3 million asset, that $2 million that we're not replacing may be treated as taxable boot. We can allocate that to a DST and give you the full deferral. So it's a great complementary option that will help open up some options for the exchanger. It's also a great way. It's a good backup for your identification sheet. So I often say if you identify 3 properties that you really want to buy, let's identify a 4th under the 200% rule if we can. That is a DST, and that DST will serve as a backup in the event we can't close on one of our primary direct title options. It can also be a great immediate identification tool. So if we're in late in our ID window, we're at day 30 and we don't see anything we like. Now it's day 35 and we're starting to think, man, what are we going to do? That's a great time to be thinking about a DST. Well, a great time to be thinking about a DST is back before you sold the relinquished, but that's a great opportunity for you to still keep the exchange on timeline by incorporating a DST when we need that immediate identification. And then finally is as a creative debt replacement. So just as I said, the debt on the DST is non-recourse to the investor, but the investor gets credit for the debt in their replacement calculation. So if somebody is selling a high dollar property with a very low debt balance, we can replace the debt using the DST, and the exchanger doesn't have to go through the direct borrowing headaches or pay origination costs to get the debt themselves. They can just use the DST, replace the debt using the DST, and then with the remaining cash of the exchange, go buy something all cash. So a couple of different ways that we can use the DST in the exchange. It's important that anyone going through a 1031 exchange or considering one understands that this option is available to them in the marketplace. It can save or simplify an exchange. I want to go through a couple, getting close to the end here, but I want to go through a couple quick example case studies with how we would build an exchange case where we incorporate a DST. So I want to introduce 2 fictitious example DSTs. The first DST property is a 250 unit Class A multifamily property. It's a $80 million offering price, but 40 million of it is being raised from investors, and the other 40 million is non-recourse debt. So that means there's a 50% loan to value, and the distribution expected on this property is 4.5% in the first year. That's based on the amount of equity that's been invested. The second example DST, DST number 2 here, is an Amazon distribution center. So this is an industrial property with a $100 million offering price, but no debt. And this offering projects a 5.1 or 5.0% distribution. So these are the 2 example DSTs we're going to look to incorporate in our exchange. I just have them back up here as a reminder, but the first scenario we'll look at is where we use these DSTs as a primary replacement option. So the scenario is that an investor sold a rental property for $2 million and they have a $500,000 loan that they repaid on closing. So representing a 25% loan to value on the sale of their relinquished property. That leaves them with $1.5 million of equity proceeds that they are able to invest. So how might we build a replacement property portfolio in this exchange scenario? Well, we could simply take that $1.5 million of equity and split it across DST1 and DST2. So you can see by investing $750,000 in DST1, the investor is credited with an additional $750,000 in debt, And so their closing statement will actually reflect a $1.5 million purchase. And then the remaining $750,000 of equity proceeds is invested into DST2. There's no debt, so their closing statement will just show the 750,000. But when we add the 1.5 million to the 750,000, we get a total purchase of 2.25 million. So our requirement again for a full tax deferral is that we reinvest all the equity, which we did here, and we replace all the debt, again, which we did here. So we purchased $2.25 million worth of property, and that should give a full tax deferral to the investor. The resulting income is a projected distribution in the first year of ownership of about 4.75%. So this is a good outcome for a client that's looking to use the DST portfolio as their primary replacement option. The second and final example we'll look at is a complementary replacement property option. So this is where we're just going to use one example DST for this scenario, but the scenario is the same. So we sold a $2 million asset. We repaid a $500,000 loan. That leaves us with $1.5 million worth of equity. But the investor really likes a single family residence that they want to acquire for $1 million all cash. So in this example, they've spent $1 million on single family residence number one. That leaves them just with $500,000 worth of equity. So the exchange solution here would be to go ahead and invest the remaining $500,000 into DST1. Because they have debt on this DST, they're credited with an additional $500,000 worth of debt, and their closing statement reflects $1 million worth of property purchased. We add that to the $1 million that they purchased in single family residence number one, and in total, they purchased $2 million worth of property. They've reinvested all the equity. They've replaced all the debt. That means they're likely granted a full tax deferral on this exchange. And then their first year projection for income will be 4.5% on the DST equity, plus whatever income they generate on the single family residence. So this is a way to use a DST as a complementary option to a direct title purchase. I've got a third option that's a backup scenario, but we'll just skip through that. That's where we can just add the DST as a backup identification, and that gives me. I thought in my mind I would use 50 to 55 minutes. We're at 53 minutes right now, but this is my contact info. Feel free to reach out anytime. My phone number and email: trevor@aimpointinvest.com. You can also go to my website, www.aimpointinvest.com. I've got some downloadable tools, exchange calculators, some brochures on DSTs, all free and available to download for anyone interested, as well as some additional information that you can use to educate yourself on these very important tax tools. With that, I'm going to stop sharing my screen and Linda ask if there are any questions that I can address.